Hello, everybody, and welcome to our virtual tax school webinar series. My name is Amar Medic, and I am the product marketing manager for TaxWise. In today's webinar, we'll be covering business return basics. We will go over the ins and outs of 1065 and 1120S business returns and walk you through the process of filing a partnership return using TaxWise Online. Please keep in mind that we do try to host one webinar per month, so join us in the future if you find today's session to be informative. Throughout the webinar, you'll be able to submit questions to the team and get those answered live at the end. And with that said, I'm very pleased to introduce our presenter for today, Mr. Ryan Hubbs. He is a solutions architect here at Wolters Kluwer with years of experience working in the tax industry. He'll be sharing his insights on how to prepare business returns. And with that, let's get started. Ryan, please take it away.
Okay, thank you for the very kind introduction. Like Amar said, my name is Ryan Hubbs, and I'm going to be the one that's giving the presentation today. And this is definitely one of the presentations I really enjoy giving. When I was first starting out preparing tax returns, I worked for a CPA firm, and I would say the first 100, 150 tax returns I did were all 1040s. And because of that, the business return became a very daunting task when I was finally supposed to start working on them. I thought it was going to be very difficult. It'd be much more complex. This is a big business as compared to an individual. But I think what you're going to see today is the business returns can be, and I think the key word there is can be, very simple. A lot of it's really going to depend on the size of the business. If you have a business with like 10 or less employees, a lot of times they're not going to qualify for all these credits that are out there, and it will be a pretty straightforward process. So really going to be my job today to go over the 1065 and the 1120S. Now there's a lot of overlap between both of these. As a general rule, if you can prepare a partnership return, you can prepare an S corp return, and then vice versa. There are some subtle differences and intricacies between them, but at its core, when you're in the tax software preparing the returns, it's going to be very similar. So how today's presentation is going to be set up is really the first half of this will be mostly in PowerPoint. I'll be kind of explaining some of the basics and the terminology that you probably need to know, especially when talking with your clients. And then once we go through some of the more generalized items, I will go ahead and we will go into our tax preparation software, and we're going to do a live example. And really specifically, we'll talk about the preparation of the 1065 and the 1120S. How are we going to go put in the financial, records into the tax return? And then two, we'll talk about how that data correlates back to their individual 1040s. They're really linked together. They're really a team. It's the easiest way to think of it because they're going to get the K1. So a couple slides to kind of start off with. Just want to put a face to the voice, as I think that's always helpful, and just give you a very brief background on who I am and why I'm the person giving the presentation today. My name, Ryan Hubbs. I'm a solution architect here at Wolters Kluwer, and solution architect is a real fancy way of saying I'm a product specialist. It's really my job to know the tax code and know how our products work, so I can go and give one-on-one demonstrations to various potential clients. And my background is in accounting. It's what I went to college for. It's what my degree is in. And I lived up in DC after I graduated for maybe 6 or 7 years and worked for two CPA firms up there and did a little bit of everything living in DC. I did some work with the government, I did some audits, but most of what I was doing was taxes, taxes, taxes. Both firms that I worked with, that was their specialty, was they weren't too busy during the slow season, but once busy season came around, it was 80, 90, 100 hours a week doing tax returns. I've done quite a few busy seasons like that. So I can definitely relate to the grind and the struggle of trying to get through so much work in a very condensed amount of time. And just a brief introduction to Wolters Kluwer. Wolters Kluwer is one who is hosting this presentation today. We also create tax software that I'm sure many of you on the call are going to use. We'll be using some of that tax software on today's presentation. I typically don't go through and read this slide, but I think it's just kind of showing off the credentials of the company. We work with some very well-established big firms, but we also work with a lot of sole proprietorships that are just one-man bands that don't have a big team, and we kind of have solutions for everybody that fits anywhere on that ladder of size of firm. Now, today's objectives, like I said, we're going to be starting off more so with some of the generalized items, terminology, due dates for returns, and then we'll be getting into the more practical examples using a tax preparation software. And I think really the first place to start is going to be like the basics, identifying who files a business return, and really how is this all going to be reported. When it comes to a 1065 or an 1120S, really is it's really an informational return, right? There's really no taxes due when we complete one of those returns. Any taxes due, any credits that they receive, it's all going to flow back into their 1040. So they really are linked between the two of them, and we'll talk about how that's all going to look. All this linking that I keep referring to is going to be reported on the K1. Now, if you've done 1040s, you've probably input K1s more than almost certainly, right? And really the main purpose of a 1065 or an 1120S is to generate the K1. So the income, expenses, everything is going to be reported on the 1040. That's why I'm going to keep referring it to as an informational return, as the taxes aren't actually due when you file the 1065 or the 1120S. It's all going to flow into their 1040 and be due there. But the main thing that you want to get out of preparing a business return is, one, you got to make sure that the financial information is being input correctly, and then two, you have to make sure your K1 is correct before you start inputting the 1040. We're going to talk about some of the due dates and penalties. As a general rule, when it comes to businesses, the IRS penalties are much more strict, or maybe severe would be the correct way to put it. It definitely is going to scale in terms of size of the company. So as the company grows, if you do miss a due date, those penalties are going to massively increase. So even more so than your 1040s, you really have to dot your I's and cross your T's when preparing one of these tax returns. Now, moving into our next slide here, I'm going to be using TaxWise Online to really give you practical examples of preparing one of these tax returns. And, TaxWise Online used to be 1040 only software, and there was an older desktop version where you would prepare the business returns. Last fall, we went and released the 1120S and the 1065 to the online version of TaxWise. So now you can do the 1040, the 1065, 1120S. It's all going to be in the cloud-based program. If you're thinking about switching to TaxWise, any additional forms like the 706, 709, 5500, those are still going to be done in the desktop version. So I just want to go ahead and highlight that. But in today's presentation, we will be going over the 1065 and the 1120S. So let's go ahead and talk about the common types of business entities for tax purposes. Now, this is not meant to be an all-encompassing, all-inclusive list. What you will see with different types of returns is a lot of times there's subtypes as well. So, for example, a corporation is filled out on the 1120 form, but there's different variations of the 1120 there, and I don't just mean the S. There's an 1120H, for example, which is going to have to do with like homeowner associations, those HOA fees that we wish we didn't have to pay. And there's a lot of subforms now. It's kind of out of our scope as far as going over just the normal 1120S or all of those, sub forms that could go with it. And the main reason I don't focus on that form is, by and large, when it comes to preparer firms or even smaller CPA firms that are most likely to be attending this presentation, corporations are usually not the go-to entity type. If a company has the option to pick between an 1120S and just a normal 1120 corporation, it's almost always, I won't say always, but almost always going to be more beneficial for them to elect to be an S corporation. Now, not everyone can be an S corporation. There's going to be some pretty strict rules in regards to it as far as the size of the company. So as the company scales up, the company grows. Eventually, they are going to have to become an 1120 corporation. But for those smaller size firms, S Corp is almost always the better option. And in general, I would say most people attending a presentation like this today, they're much more likely to be working with a smaller size corporation, which means they're probably going to be an S corp, right? I think most of our customers know. All you have to do is a quick Google search to know that S corp is going to be more advantageous from a liability and risk standpoint, as well as really what they're ultimately going to owe on their tax returns. Now, also have the limited liability company. This you may run into more than a corporation. We're not going to go over it today, but I do want to make you aware of it. Really, the LLCs are going to take some characteristics of an S Corp and some characteristics of a partnership, which will generally give them more flexibility, specifically having to do with, like, if you're an S corp, there's kind of some hoops you got to jump through in order to make sure you're in compliance with how the business is set up, how many shareholders there can be. LLC is going to give them more flexibility, and it's going to more so mimic the partnership as far as their taxes, but more so is probably the key word there, as the S corp and the partnerships, when it comes to the taxes they owe and how it's reported and how it's going to look, it's going to be very similar. So today we'll be going over the S corp. We will also be going over the partnership as well, probably with a little bit heavier of a focus on the partnership, but we will look at both. And then I'm going to show you some tools that you could get at your disposal kind of at the end of this presentation, where let's say you are running into like 1120H returns, for example, where you have a lot of LLC limited liability companies. I'm going to show you some tools that you can rely on to make sure that you are preparing these returns correctly, as well as if you have questions or you run into something on a tax form and you're not quite sure, I'm going to show you a resource that can get you really amazing answers very, very quickly. So we will be looking at that kind of towards the end of this. Now, jumping into what is a partnership. Now, I think the main thing that you have to know for this presentation is going to be a partnership must have at least two partners to do trade or business. You cannot have a partnership with just one partner within it. Now, the partnership can scale upwards. It can be much more than two partners. And I think the easiest way to kind of think of this is like a law firm or even a CPA firm in some examples, where I mean, working a CPA firm, like, you have partners, right? You have the individual people that have either started the business together or they've come in later and probably bought their way into being an owner into that business. It's going to be the owners when I say partners. And, really the biggest difference between this and with an S Corp is an S Corp, the partners are called shareholders. It's the main difference between the two. Now, it's not each and every employee. If I'm running a law firm with my friend and we're the partners, we've bought in, ultimately we're the people that are going to get the K1s. We could have 200 employees that work for us, but those are not partners. They have to be invested in the business. And I think the easiest way to think about invested in the business would be that business loses money. Who's on the hook? Who's going to feel that financial pain? The employees probably aren't. The employees are going to be on salary, right? Or they're going to get paid hourly. So it's really the people that have the most financial risk involved with that company, but they specifically have to usually buy in, or I guess in rare cases, they could be given ownership equity within the company for free. But once they have ownership, you're going to think of them as a partner. You're going to think of them as a shareholder. Now, partnerships are going to report its income and expenses on Form 1065. This is the U.S. return for partnership income. Really, only difference with this, with the 1120S, is going to be shareholders. Once again, is going to be the proper terminology, whereas with partners, you just use the word partner. Moving through, both of these are going to be pass-through entities. This is why I keep referring this as to an informational return. When I say the word pass-through entity, it means that we're going to fill out the 1065, we're going to fill out the 1120S, but they're not going to be taxed at that point. Now, there still may be taxes that are ultimately going to get paid. I would say that's highly likely, but the taxes are going to be figured out on the 1040. So all of their income, all of the expenses that this business made through the year, that is eventually going to be generated on the K1. And the K1, when it's created, it's going to be created on the 1065 or 1120S, and then we're going to data input that K1 onto their 1040. So really the only goal of the 1065 and the 1120S is to make sure that we are getting the accurate financial records and inputting into the software correctly so the tax return's correct. But it's really not enough just to do that, because ultimately all of this information is going to have to be re-input, and albeit a more concise manner, using the K1 into their 1040. I think we pretty much just covered this next PowerPoint slide here, but partnerships and S Corps receive a Schedule K1. And I probably should have changed the terminology. They most likely generate a Schedule K1 as opposed to receive, which is going to report their share of income and expenses. Now, technically having the word receive here is not inaccurate, because as I go through this presentation, the most common place for the K1 to pass through and flow into is into a 1040. However, It's not always necessarily the case. You can absolutely have a situation where one business owns part of the S corp, or a partnership owns part of an S corp, or whatever, either one of these. And if let's just keep it simple. Let's say an S corp owns another part of a pass through entity. Uh, in that instance, the other business that owns the subsidiary would receive a K1, and you would report the K1 information on the business return. Now, ultimately, it's still going to flow through to the shareholders. It's still going to flow through to the partners, depending on the type of return. Now, this is a little bit more rare for like the smaller size firm segment. I'm not saying that I've never run into this. I absolutely have. But by and large, with smaller firms, the 1120S, the 1065K1s will flow through into a 1040. Now, as things scale up and you get into bigger businesses that have 80, 90 shareholders, many, many partners, the bigger the business is, I would say the more likely it is for them to own another business, or at least a part of another business, and they would receive a K1. But this is going to be a little bit more advanced. If you're running into this situation, you probably are pretty proficient with filling out a 1065 already, or an 1120S. So it's a little bit out of the scope of like a basic presentation like this today, but just do want to make you aware that this is a possibility. So if you ever see this, just be aware that doesn't mean that something's wrong. It just means they're in a more intricate and advanced situation. Now, I've talked about this a few times, so not going to elaborate too much, but the partners or shareholders will report what is on their K1 on their Form 1040. I'm actually going to go into the software and show you what those data input worksheets look like. Now, if you've been doing 1040s, you're probably already aware, but I do want to close the loop and make sure I'm giving you a very comprehensive overview. So we'll kind of look at how you're going to prepare that within a tax return as well. And then lastly, a partnership return is due March 15th. This is the big business filing deadline. Now you can extend it to September 15th, but the main thing to kind of take away from this is don't be late. Don't be late. I mean, you should really never be late on any return, but if you had to pick and choose between being late on a 1040 or being late on a business return, it's probably going to be more beneficial to be late on the 1040. Like with the business returns, especially as that business grows and they have more shareholders, they have more partners, the fees are going to scale upwards. So it can get very, very expensive. Now, last bullet point here, steep penalties. And to really talk about those steep penalties, the penalty for filing a late partnership return is $220 for each person that was a partner at any time during the tax year, for each month each month or part of the month that the return was filed late for up to 12 months. So if I have 10 partners or 10 shareholders and I'm 1 month late, that's over $2,000. If I'm 10 months late, that's $20,000, more than $20,000. So that's what I'm saying. That's just with 10. I mean, if you run into a larger size firm, that just scales up for each and every person that has an ownership equity within that company. So extremely, extremely important to make sure that these returns are either being filed on time or extended on time, as it's going to be a very difficult conversation to have with your customer if they do start incurring these, quite frankly, pretty steep penalties, in my opinion. So if this is something that's new to you, if this is something that you haven't really been doing business returns, but you're kind of dipping your toe in the water, you're thinking about, am I going to take this next step? I would say the main thing is do not be late. Do not be late. Know the deadlines. Make sure you know the extension deadlines, and just get these things done as appropriately, as timely as possible. And really, they probably need to take priority over the 1040s. Now, the good thing is, if I go a couple slides back here, the due date, where did I have the due date? Here it is. The due date, as you'll notice, is March 15th as opposed to April 15th, right? So if you do bring this on, what you're going to feel is this is going to be kind of a natural transition to where you're just going to have two extremely stressful and probably hectic deadlines, but at least it's not all at once, right? That we do kind of have a month gap there where we know our focus needs to be on the March 15th deadline. Now, the only place where this can get a little tricky is the deadline's obviously a month earlier than the 1040s. And sometimes we're waiting on K1 information, right? It's we don't always have the clear financial picture that we need to prepare this return all at once. So usually what I'll recommend is get as much of your business return as you can get done and kind of leave yourself at a point where you're really just waiting on the K1s. So as those K1s come in, you don't have this massive workload, as you are going to probably have quite a bit less time to prepare these partnership returns, to prepare the 1120S returns. Now, want to go ahead and open this up to our first polling question, and just kind of use this as an attention check. Now, today I've made the polling questions, I think, quite a bit easier, so hopefully most of you will get this right. But I just have the first question being, what is a partnership? And I have two options, so you got a 50-50 shot even if you're not paying attention to get this right. But I have a partnership can still be considered a partnership even if there's only one partner. And B, a partnership files Form 1065, which produces a K1, which reports the partner's ownership share on the partner's income and expenses. I'm going to give everybody a bit of time to go ahead and answer this question. And so far, we're at 100%. I really like to see that. And then, after we get through this, we're about to go into TaxWise and start talking about what it's going to look like within the software, what are the key worksheets that we're commonly going to use. But we're still at 100%. So I'm hoping this would be the first time I've asked a polling question we got 100%. So hopefully it sticks with this. Going to give you all a little bit more time to answer, and then I will come back here and give a very brief explanation as to the correct answer, and we will move from there. Okay, and so one person missed this. I almost have to wonder if they intentionally missed it just to be funny, but uh, everyone else got this correct. So, a partnership has to have at least two people in it. If it's not that, it's probably more likely going to fall under like an LLC or a single member S corp firm. You do have to have at least two people, but we are going to fill out the 1065. We are going to have the K1, which is going to report the share of income and expenses. So, moving to our next slide, I have this what could be fairly confusing if you've never seen one before, trial balance. And when it comes to preparing a business return, ideally, this is what you want. You want a trial balance that's going to list out uh, their assets, like cash, accounts receivable. It's also going to list out what they owe other people, like accounts payable, and it'll show how much equity they have within the firm. You can see Charles and James here. You can see how much they bought in for, what their equity is going to be. And then it should also, once you get past the assets and liabilities, have the income, should have the expenses. And this, if you can get this and you can get your clients to keep accurate financial records, this is your key to getting through one of these business returns extremely easily. Now, I understand that we do not live in a perfect world where we're always going to get really neat, really clean trial balances or even financial statements, right? We all have had customers, we've all had clients that sometimes they're just giving us like notes, like they just kind of eyeball it, guess, write it down on a piece of paper with pen and pencil. I understand that that's most likely going to happen sometimes, and we can only do what we can do to fix that. But as you start getting into more advanced tax returns, uh, specifically with like K1 info, the more accurate and more detailed the financial records are, like a trial balance, the better their tax returns are going to be. Now, if you're doing bookkeeping for your customer, you probably know that QuickBooks Online or Xero or one of the other accounting softwares, it's going to produce this trial balance for you. And it may not be 100% ready to go. Usually we have some adjusting entries that we need to do in order to kind of take it from the end of year balance into the tax balance. But we at least have a really good starting point to get this business return done. Now, for those clients that aren't giving us financial records, uh, it's something that you are individually going to have to personally think about if you want to do their business return as well. And the reason that I say that is if it's a really simple business, you may feel comfortable just kind of taking their notes or their what is likely to be estimates and preparing the return. But it does put you at financial risk, and it really puts you at double financial risk, meaning If they mess up the numbers on their business return, well, now their 1065 is most likely wrong, right? But it cascades into a bigger problem because if the 1065 is wrong, any partners or any shareholders that are going to receive a K1, now those K1s are wrong too. So at its core, or at its minimal problem, it's going to be two returns are wrong. Yeah, the business return is going to be wrong, personal return is going to be wrong. Well, if you run into that situation where you're doing a partnership's return or S corp's return, and you're doing all the shareholders and you're doing all the partners 1040s as well, now all of your returns are wrong. So if you cannot get accurate financial records from your company, I am not here to tell you how to run your business, but I am here to warn you of the risk because you're going to have multiple returns that are shaky at best. And if you get audited or they get audited, I guess would probably be the better way to put it. Uh, it's a lot of risk. And when I was first growing, I would kind of take on any client that would give me the time of day because I wanted to grow, 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 grow. But once you hit a point where you don't feel the need to grow anymore, you're pretty happy with the income and the workload that's coming in. Uh, Clients that aren't giving you this would be top of my list to replace with better clients. So, with that out of the way, and my little aside there out of the way, what we're going to do is we're going to finally get into a tax return. You're probably saying, wow, I can't believe we haven't gotten into a tax return yet. But really, the reason for that is it's kind of easy to prepare these returns, in my opinion. Now, maybe the first few, if you've ever done one, it's going to feel a little bit different and might be a little unfamiliar with where you're going to go. But the actual input worksheet is it's easier than a 1040, I promise you. So where I'm going to go is I'm going to go to my tax returns, and I have a few different returns here, but we're going to start off by going into a 1065. When I go into a 1065, I'm going to first bring up like just page one of the 1065, and if you've ever prepared a 1040, it's somewhat similar. I'm not going to say it's exactly the same, but really where you start is with the basic information of the company. What's the name? What's the address? What's their what's their zip code? EIN. So instead of a social security number, they'll have their own business number, which is just slightly different, but you just have to make sure you get it correctly, enter it correctly. And then we'll come down here to probably the first area that's going to require a bit of thought. So we have cash basis of accounting, we have accrual method of accounting, we have other. We're not going to talk about others, it's very rare. But really, these are the two, and you need to make sure that you get this correctly. And this will typically, once you get this correct, year one, uh, it most likely doesn't change. Could change, but most likely it won't. And just to kind of briefly break down the differences, the accrual method actually is the method that's, in my opinion, much more popular, especially for any business of any size. And it's simply, I think the simplest way to explain it on a presentation like this is that as soon as the money is earned, it is reported as income, or as soon as the expense has happened, it is going to be reported as an expense. Meaning, if I go and make a sale for, we'll just say tax software, right? And I've sold the tax software, they've downloaded the tax software, they're using the tax software, but they have not paid me for it yet. It's still going to be income. Doesn't matter when I get the cash because they owe me. So that's, I would report that as income on the current year financial statements. The cash method, just follow the cash. Uh, I may have, if I'm using the cash method, I've given them the software, they've bought the software, but they haven't paid me yet. It's in accounts receivable. Well, until I get the cash, I do not report it as income. And the inverse is correct of this for expenses. Now, typically, I will only see the cash method used for extremely small businesses that maybe aren't keeping great books, as they may not need to keep great books, as it's just a small business. And sometimes it can be a little bit easier with the cash method, but for any business of any size, usually they're going to be using the accrual method. And if they have an option or they're asking you which one, I would typically recommend accrual. Now, as we continue to scroll down, number of K1s, well, every partner or every shareholder, if it's 1120S, gets a K1. And, as you go and input the partnership information, you'll see this number tick up upwards automatically. But really, once we get down to the income, once we get down to the deductions, yes, the titles that I'm highlighting are different than a 1040, but it's the same general theme, right? We're going to start off with our income. We're going to start off with then once we've done the income, we're going to go ahead and move forward to our deductions. And if you're on a 1040, box 1A is wages, and it just changes a little bit, right? It's set up for a business, obviously. So it's gross receipts and sales. Now, for my tax preparation software that we're using, TaxWise, it's going to tell you where these different amounts are input. And sometimes I'll just type directly onto the form, or sometimes there'll be a worksheet that's going to really pull this information. Now, the highlighting is what tells me this. Anything in green uses a worksheet. Anything in black could have a worksheet, but I have the option to just type it in. Now, as a general rule with the business returns, uh, you're by and large going to use one worksheet to fill out their financial situation. And there will be other worksheets that you may add in down the line for more specific scenarios or cases that are items they may be running into. But there's really one worksheet that you're going to use to prepare the vast majority of either business return, whether it's an 1120S, whether it's a 1065, it really doesn't matter. And what that's going to be called is the trial balance worksheet. And if I have already gone and input this into the tax return, but if we go to the trial balance worksheet listed here, this is your guide. This is the worksheet that you will spend the most time looking at. And you may notice that when I was in PowerPoint, I was talking about the importance of a trial balance. Well, it's because we have a trial balance worksheet that's going to do the work for us. And we're going to kind of go through and I'm going to input into this, but how this is going to be broken down is into two sections. We're going to start off with assets, the liabilities and equity, and this is on different sides of the screen. And then when we scroll down, we're going to get to our income and expenses. Now, I think probably if I was new to this, I think the income and expenses is what we all focus on, right? They've been going and selling things throughout the year or providing services throughout the year. They've made money. And as a part of that, they've had to have expenses to run their business, whether it's a vehicle expense, whether they're buying materials. You know, there's a million different things that could be an expense, right? This, I think, is the easier, more intuitive part of it, and we'll probably end up here. We'll probably start with the assets and liabilities. So with the assets and liabilities, this is just what the company owns and the things that the company is on the hook to pay off. And the reason to really start here, at least on the presentation, doesn't really matter where you start. If you're doing the tax return, you can start either place. But why I'm going to start here for this presentation, so we're going to be referring back to our trial balance quite a bit. And when we go through and we look at this trial balance, uh, it starts off pretty much every trial balance uses the same format, and they always start off with the assets. It then moves to the liabilities, and then it'll go to the owner's equity. And really, it's the first 6 or 7, I would say, accounts that are going to focus on this within this particular trial balance. Uh, and the numbering is also going to be important. So like usually an asset is going to start with a 1. Now, how many digits appear after it can really vary from entity to entity. Sometimes it's in the hundreds, sometimes it's in the hundreds of thousands. And it's really unimportant what the exact number is. But really, if you want a hint as to where this is going to go on the tax return, look at the numbering. Like I can tell my first 3 items, I have a cash count, another cash count, and accounts receivable. Well, these are all assets. These are all things that are good for the business. These are all things that are going to start with a 1. Once we get to accounts payable, it starts with a 2. All my 2s are usually going to be liabilities. These are things that the company has received the service for, if this is a accrual method, and they're on the hook to go ahead and pay off whoever they need to pay off, but they haven't done it yet. Once I get into the 3s, I have capital for Charles, I have capital for James. This is the owner's equity section. You know, what is the breakdown? What is the share between them? And we can kind of tell, given this basic example, Charles owns 60% of the business. James is going to own 40% of the business. It's right here for us. Now, once we get into the 4, 5, 6s, these are going to be revenue. Anything with a 4 usually has going to be revenue, and then 5s and 6s is going to be your expenses. So we're going to start off with the assets. So it looks like I have a couple cash accounts here. I have a cash account for just like small purchases, petty cash. It's $1,000. And then I have a regular checking account with quite a bit more money within it. Well, if I'm going and preparing their tax return, which I've already input some of these figures just for time, I'm going to go find the cash section within my trial balance worksheet. And we do have 2 cash accounts, right? We have petty, we have regular checking. We do have 2 cash accounts. We do need to report both. And more importantly, we need to report both individually. We should not be combining these without giving context and clarity on the tax return. So when I go to cash, I've actually gone and made a statement where we can go and report both And this statement is going to be a scratch pad. And I could either just click on the scratch pad down here, or I could click this little arrow, link it back to the scratch pad. Really, either way is going to work for us. But I will just go and click on the scratch pad, and this is how I've broken it down. I've gone ahead and input account one, the $1,000 in petty cash. Gone to account two, the regular checking account for just over $100,000, and then the total amount flows back to our trial balance worksheet. Now, as I go through and fill this out, I'm going to just constantly be referring back to the trial balance. I'm going to be clicking back and forth today because I can only share one screen, obviously, while on a presentation, but you're preparing business returns, you definitely want to have at least two monitors so you're not just constantly clicking back and forth between the two of them. Now, the next account on our list, the next asset, I should say, on our list is going to be the accounts receivable at $30,000. I'm going to go ahead and find our trade notes / accounts receivable. It could really be both. I've already input the $30,000 here. There's really no need to make a statement or a scratch pad for this because we just have the one account, right? Now, the trial balance that we're using as an example is a very basic trial balance, right? Like usually there's going to be more than like 15 accounts. You're probably going to run into, I'd say at a minimum, like 40. But you could technically have one that's really simple like this, but usually you're going to have to, in greater detail, put in all of these assets, at one time. And once you get to the accounts payable section, like you're most likely going to have more than just one account. But I went ahead, found accounts payable, input the $6,000. Now, as you can see, there are more asset categories here, and there's a couple of reasons for that. One, the IRS really wants a more detailed breakdown of what all they own. We can see things like inventory would be pretty common. Tax exempt securities and like government obligations, probably not overly common. You may run into it from time to time, but there will be a catch all for anything not listed up above called other current assets. Current assets are assets that are going to be assets for less than 1 year. Whenever you see current, whether it's on the asset side, the liability side, it means it's going to be less than 1 year. Anything that's going to be longer than 1 year is going to be a long-term asset. And sometimes it can take a little bit of digging to find out how long something's going to be on the books for, but it is important to get these in the correct categories. We can see our depreciable assets right here. If you've done a 1040, you've probably done depreciation. You will subtract out the accumulated depreciation here as well, and this will still be reported on the asset side. Just because you've taken the depreciation doesn't make it a liability, right? It just means the asset's worth less than when they originally bought it. So it's not necessarily just like things that make them money or make their financial situation like greater on the left, and then bad things or things that are detrimental to their financial situation on the right. There's going to be a little bit of flexibility in this. Like it's perfectly fine to have assets that deteriorate and then value over time, and still going to go on the asset side because technically you don't owe anyone for this accumulated depreciation. It's just the asset's less valuable. It's not like you need to pay anyone because it's less valuable. It's just less valuable. But once you're done with the left-hand side of this, it'll go ahead and total up your assets, and then you will move over to the right-hand side. You will get into the liabilities and equity account here, and I already went ahead and put in the $6,000 for accounts payable. And then, mortgage loans less than 1 year. Once again, this less than 1 year, more than 1 year is very common. You see other current liabilities. Whenever you see the word current, it means it's just less than 1 year. This liability is going to go away. I think a common example is a credit card. By and large, credit cards, hopefully at least, we're going to be paying those off in less than 1 year's time. But then as we continue to scroll down, we just get to the section where it's everything that's more than 1 year. We have mortgages, loans, etc., more than 1 year. It's not uncommon for someone to receive a good or service, or they're going to continue to receive a good or service over a long-term period of time, and they're going to pay it off, not in the next year, but maybe the year after that, or whenever. And then we just have the other section here. And so if you don't see the word current, you just see the word other, it just means these are all the liabilities that are not going to be paid off in more than 1 year. And then we would also have to put in the ownership equity. Now, that's one of the few things that you will kind of put down in here at the bottom. Now, you'd want to break this down like we did before. So what I would do is I would go and add in a scratch pad for the capital accounts, like so. And I'm just going to think their names were James Capital. I think he was at $40,000. I will refer back to my trial balance. James was at 40. We have Charles at 60. And this is really it. Like, this is why I say once you get kind of proficient with the trial balance worksheet, this is where like most of the finances are going. And really the benefit of this is as we need to go in and add in new forms to complete this tax return, it just pulls the information out of the trial balance worksheet. Like we just input this once, and then as we need to add in forms for their specific situation, uh, it just pulls the information out of here. That's why it's kind of, unless it's a really complicated business, in my opinion, easier to do one of these business returns. Now, one thing that is a huge problem within my trial balance is, this is something that will drive you crazy, I can guarantee you, is the assets need to be exactly the same as the total liabilities and capital. And if there is a discrepancy with these two numbers and they are not to the dollar amount exactly the same, uh, your information's wrong. I'm not saying you input the information wrong, you may have, but your information is wrong. So you really want to make sure that before we start working with this trial balance, everything is going to add up to one another. Like at the very bottom here, you see where it says debits 156,000, credits 156,000. If these two numbers down at the bottom do not match up, you should not start working on the tax return. They need to be in balance with one another. If these two numbers are different, there's a 100% chance your tax return is going to be wrong when you actually input it. There's no way that you're going to get a correct and accurate tax return. And typically these will be adjusted with adjusting entries. That's kind of a little bit out of the scope of this presentation, as there's not really enough time to go over it, but just be on the lookout. If these don't match up, something's wrong. 100% something is wrong. Now, once you get past the assets and the liabilities, you're going to come to your income and expenses section, and this is probably the more intuitive of the two sections, is this is like more so like what you think about like the day-to-day running of a business, right? As we go and run our business day to day, we're going to have sales, we're going to have returns, we're going to have materials we've purchased, we're going to have depreciation expenses. Like this is really where a lot of this is going to go. So I've already input a few items like the gross receipts or sales. I've gone ahead and subtracted out the returns and allowances. Once again, they have returns and allowances. They're really not paying anybody, and they can go and resell the goods, right? So it's not necessarily an expense. It's just we need to take this out of what we sold for the year, since these obviously were returned and we're not receiving any financial benefit to having these items that were returned. But as you go through this, I mean, the categories are fairly self-explanatory. We have rental income, kind of hit or miss if they're going to have this. I'd say it's less common, but occasionally you'll run into businesses that really specialize or own buildings, and you'll fill that out. Gross rents, we have farming income. Once again, this is more hit or miss. I've personally never done a Schedule F in my life. This is one of the few forms I've never actually done in practice. I've always lived in big cities. But if you have it, you just fill out the Schedule F here to make sure you have an accurate detail, but there's nothing stopping you from just typing it into the corresponding field. And then as we go through, gains or losses from asset sales, state tax refunds are going to be treated as income here. So they were most likely treated as an expense in the prior year tax return. We'll have interest, dividend income. Now, this is really getting into when they own assets, right? They own stock. This is more so for larger, mid-sized businesses, royalties, portfolio, other non-taxable income. And really, most items are going to fit into one of these areas pretty neatly and cleanly. But if you can't find a place, if you're looking at your trial balance, you can't really find a place, just pop it into other income. This will be your catch-all, where if something is not listed and you don't feel like there's a proper category, just put it into other income. This is going to be the best place to put it. You'll most likely make a statement for all these items. And once again, if we refer back to our trial balance, I mean, a lot of businesses are just going to have sales. It's not uncommon for them to just have the sales and or the services as well. Could be the services that they offer if they're professional, offering professional services. And you'll probably spend more time on the expenses section. And I have quite a few expenses here. Now, I've already gone and input a lot of these into the tax software. Now, I think the main thing to know is you just kind of find the category code and you put it where it's supposed to go. A lot of times you will be putting your own accounting expenses that you charge them into this field here. So always a fun one to see how much they paid you throughout the year, just to keep track on it. But you fill out this section. And then, like I said, it's going to go and flow throughout this entire return. And as you need to add in more forms, you need to add in more worksheets, financial data really pulls out of here. Now, occasionally you may need to add in some additional context, some additional information, sometimes a lot of times non-financial information. But this is really the main worksheet. This is the worksheet that has to be right. And if you can get this worksheet right, you're well on your way to preparing the tax return correctly. I think last thing to kind of point out about this, earlier with the assets and liability, I'm like, these two numbers have to match. Income and expenses don't have to match. And honestly, you probably have your fingers crossed that they don't. You want the income, hopefully, to be much higher than the expenses. It means they're running a successful business, but occasionally the expenses will be higher than the income. Definitely happens, right? Plenty of businesses go under. Really not our job to finagle the numbers and get fix it so they are making money. You just have to call it as you see it, report it as you see it within the tax return. Now, I've been focusing primarily on the 1120, the 1065 today. Let's go ahead and jump into an 1120S. Now, the reason at the beginning of this, I said, if you can do one, you can do the other. Well, if I open up the 1120S, it's really not that different. Starts off here with the basic information. I don't think anything too dramatic here. We have the name, the address, the EIN, etc. As we scroll down, here's our income section. And we go to our expenses section. There's a lot of, what's the right word I'm looking for? There's a lot of carryover, or a lot of similarities, maybe the best word, between the 1065 and the 1120S. But you can see all these green underlines. I mean, most of these are green underlines, right? So I'm mostly inputting the data to fill out this 1120S on the trial balance worksheet. The trial balance worksheet looks pretty much the same, right? We have our cash, our accounts receivable, bad debts, inventory. I mean, these are like the same category codes by and large. There will be some differences between the two, but really any differences that you're going to have should be within the trial balance. So trial balance may be a little bit
Hey,
different, but
Ryan, quick question. Somebody says they don't see a green underline for 1120S. I don't know.
so the green underlines are on the fields themselves. So you see gross receipts and sales. There's a green underline underneath the field. If we go to returns and allowances, there's a green underline underneath the field. Same thing for the balance here. This
Okay.
is the green underline that I'm referring to. Any of these places that have a black underline underneath of it, this is where you could potentially use a worksheet, or you could go and just type directly on the form itself. Is this showing up on your screen,
Yeah,
Amar?
it is. It is. I just want to make sure I adjust. This person had a lot of questions, and I wasn't sure that
Yeah, it's
they
just
are
these,
seeing.
like, if you look at the field, you see the underline color, that's kind of your heads up as to where this data input's going to be done. If we go to something
Okay.
like a trial balance worksheet, it's all black underlines, right? I mean, I guess there's a couple that aren't, but by and large, it's mostly black underlines. So, like, this is why we're just typing directly into these fields. And the main point that I'm trying to really get across here is that if you can do one, I guarantee or promise you can do the other. Uh, the categories are almost exactly the same. And you're really just inputting the data as you see it within the trial balance, and then moving forward, step by step through this list. And it's even set up where it starts off with assets then we have our liabilities. We scroll down, here's our income, here's our expenses. And as we go and need to add in new items, it'll take this data that we've already input and just fill out the forms for us. Now, eventually, at the end of this, what we need is a K1. A K1 is going to be the most important thing that we get out of this. This is really where the income is going to flow. Now, before I do that, I am going to go ahead. I guess I forgot to open this up to the second polling question. Going to go ahead and do this. We're going to do this very quickly as I'm a little short on time here, but I have what is a trial balance? Then I have it is a financial report that is prepared at the end of the accounting period and lists the business's account balances and debits and credits. Or B, it is another name for a Schedule K1. Once again, I'm trying to keep these polling questions simple today. Let's go ahead and spend maybe 30 seconds on this. And then I do want to get into the K1, as I think that's going to be more helpful to everybody. So I'll give you just a second. This also gives me a second to catch my breath. And we will continue forward with the K1 after this. Okay, and unsurprisingly, everybody has gotten this right. We've spent a lot of time looking at the trial balance, so I'm happy that everybody got this right. And moving forward past this, let's really get into the K1. This is really one of the more important bits that I have to go over when we talk about the preparation of a business return. Now, if you've done a 1040, you've seen this. You've absolutely seen this. You're probably pretty proficient at inputting it into whatever software it is you use. However, when doing the business return, this is going to now, instead of typing in the information that we see, we need to make this, right? We need to go and prepare the K1, where most likely we will also be doing their business or their personal return, but not necessarily. So you can run into situations where you prepare the business return for all the partners, and then this is going off to another CPA, another tax preparer, whoever, to go and fill this out. Now, the good news is if you have good tax software, it's going to prepare most of this for you automatically. And once again, I keep kind of trying to refer to this and drive this point home. All has to do with the trial balance worksheet. Once we input, the income and the expenses throughout the year, and we've specified what their ownership percentage is, it should be generating this K1 for us. Now, with these K1s, there's a couple different ways to kind of look at this within the software. Now, really what you are going to be responsible for inputting is you're going to go and make sure you have the entity type correct. Now, this is most likely going to be individual, especially for smaller sized firms. Like most of the time, these K1s flow into a 1040. But like I said earlier, if you start going into businesses that own other businesses, that's when these K1s will flow to the business, and then they'll figure out their K1, then it'll flow somewhere else, and then eventually it's always going to end up at a 1040. The ending point is always going to be the 1040, but sometimes it'll flow a couple different places before getting there. But that's kind of rare for this space. By and large, it's just going to flow into their 1040. It's a very direct input. Now, these numbers that it's coming up with, like ordinary business income, interest income, ordinary dividends, qualified dividends, I did not go and type in what this is going to be for each partner. Once again, it's going to look at your trial balance, really, particularly the income and expenses section here. And then it's going to look at their ownership percentage. So I have like beginning and ending balances. This may or may not change between beginning and ending balances throughout the year. As a general rule, if this doesn't change, it's going to be a lot easier of a tax return to figure out. But this could change. You could have certain partners or shareholders continuing to contribute money, changing what their percentages are going to be. You could have someone who's worked at the company and is now buying their way in initially into the company, and that could change what the beginning and ending balance is going to be. And it's just going to mean like as these balances change, what their share of the income is going to change. It could go upwards, it could go downwards. And same thing with their expenses. What their share of the expenses is also going to change, but it's always going to be uh, in harmony with one another. Meaning, if we have profits, it's always going to use this ending balance, right? To go ahead and figure out what the profits are going to be. If we have losses, it's always going to use it. Like you don't have to worry about this expense is at this percentage, this expense is at that percentage. You're always going to use that same percentage. It's just sometimes you may have to calculate what it's going to be by inputting like what their share of capital is, how much money did they put in throughout the year. But once again, if they're putting in additional paid in capital, it's going to be flowing most likely from their trial balance. Like it will probably be listed on here for you. So I know I keep reiterating the same point, but it's just so important that these are correct. Now, if it's just one partner, or excuse me, if it's just one shareholder, it can't be just one partner. If it's just one shareholder, it'll be 100%, super easy. But once you start to get into multiple people, that's when these are more likely to change throughout the year. Now, like I said, this should by and large be prepared by the tax software. Particularly, it should be prepared with the financial side of things. However, if we go into like a Schedule K1, for example, like it's going to highlight, if you're using TaxWise at least, like the items that have to be input for this. And usually for like a shareholder, for example, you're going to be putting in an individual or its name, right? I'm going to put in like my name here so it flows to me. I should have just put in my first name there. Did make a mistake. Let's go ahead and change that. And you can see as I go and put in these items, it's kind of removing the underlying areas. Now, if it's ever going to another business, it's like enter the entity's name, if not an individual. So there are going to be a few things that you have to do. You're going to need to have a list of your shareholders or your list of your partners. And you are going to have to kind of specify where it's going. But once we get into the financial section of this, it's all just going to do it based off their percentages. And if I go and very quickly here jump into a 1040, do just want to highlight where it's going to go. Now, most of you have probably done a K1, but I just want to kind of reiterate the point. Let's see if I have a K1 in here. Do I have a K1 in here? I might not. Let me go and add one. Just want to reiterate the point that this is the same K1 that you've been working with. Here we go. And how it's listed in my software is it keeps the K1s the same. It says partnership and S Corp. We're really using the same worksheet. And we're just going to specify. See this field here? It says P/S. This is where you're going to specify. Is it a partner? Is it a shareholder? Shareholders are 1120S. Partnerships are obviously partners. And then as we scroll down, you will see the different category codes listed here. Now, if you've done this before, this is probably a bit redundant, but if you are newer to doing taxes, maybe you're thinking about getting into this, this is what's going to be filled out. It's this worksheet right here that matches the K1. And so like if we look at box 1 of the K1, it says ordinary business income 42,891. I would come to box 1 of my worksheet, type in the amount. And then I would go back and I'd go, okay, nothing box 2, nothing box 3. We go all the way to box 5 here. We have 1017 and interest. And this is how you fill it out. So it's pretty straightforward. Like it's going to mimic the flow that you're going to see with on like the right hand side of this K1, but this is a very basic example. The credits that they could have could get very intricate. It could get very advanced. What I would especially recommend if you start running into things that don't make sense to you, I would recommend getting tax research to go ahead and just be able to quickly run these things by, like AI generated research that can get you proper answers, or we'll have articles proctored by humans that are CPAs, EAs, lawyers, etc., that you can look up any of this terminology or any of these scenarios that don't make sense. We do offer tax research called Answer Connect. I can tell you personally, whenever I'm preparing one of these presentations and I can't quite remember something, if maybe I'm a little unsure, I always go into Answer Connect, make sure I get a proper explanation of it. But it will absolutely save you time if you are working on more complicated tax returns. So with all that being said, I am almost out of time here. I was a little long-winded today. So I believe there are just a couple more slides that I wanted to go over with our remaining time. And I am looking for my PowerPoint here. I have a lot of windows open. Let me go and rerun this. There we go. So last polling question to go over, I believe, at least when it comes to general information, is true or false. A partnership is a partnership entity that will receive a Schedule K1 reporting their ownership interest of the partnership's income and losses. And this is probably the most tricky of all of the polling questions. This is the first one that I assume some people are going to get wrong. I've purposely worded this one a bit tricky, so I'm just going to go ahead and read it one more time. A partner is a partnership entity, and I should say, that will receive a Schedule K1 reporting their ownership interest of the partnership's income and losses. True or false? And then we'll give this about 30 seconds here, and then I will come and explain the answer. And a little bit of a trick question, so if you technically get it wrong, I wouldn't feel too bad. Okay, so it looks like most of these have come in. It's a pretty good mix. A few more people said true. It really could be either answer. Technically, I would say this is false because they're generating or creating the Schedule K1, which is going to go to the partners. But like I said, you could run into a situation where the partnership owns another business or the S Corp owns another business. And then in that instance, they would receive a K1. So really no wrong answers, so depending on your train of thought. But at its core, if they're going to receive a K1, That's a bit more rare or less likely, because if you are preparing a partnership return or if you're preparing an 1120S return, you will always create a K1 to flow through to the owners. That's the main thing. You always have to have the K1. If they're receiving a K1, that's going to be more so on a case by case basis. Now, the two tools that I used today were TaxWise. Specifically, I used TaxWise Online. If you liked what you saw, or you would like an additional more in-depth product demo of the TaxWise software, I do offer them. You typically need to reach out to a sales rep first. We'll also have a slide here in a second to see if you would like a demo. But I usually spend about 30 minutes, maybe an hour, depending on your questions, kind of detailing how to use the software. And then this presentation today was created with Answer Connect by and large. Now, Answer Connect is tax research for tax professionals that when they run into terminology or scenarios that are a bit more complicated and they want to go ahead and quickly make sure they're doing everything correctly, you can go into Answer Connect, type in whatever it is that you need to find, and it is a great resource. Every one of these presentations I use, a lot of it is run through Answer Connect just to make sure my examples are correct, my polling questions are correct, or occasionally I do forget things. I will go into Answer Connect just to refresh my memory. Now, do want to make you aware of a promotion that we are running currently for new TaxWise users, where we currently have a 20% off promotion. We do have, this is specifically for new users. And really, I think the main thing is you just need to add in this promo code when you go and you're starting to check out. You can see this promo code that I've put in bold. This will get you 20% off TaxWise. I'm going to come back to this in just a second, just to leave it on the screen so you can write it down in case you don't have pen and paper handy. But before we come back to this, do want to go ahead and do our last polling question of the day. And really doesn't have to do with any of the content. It's just coming back to demonstrations, which is really my core job at the company. Would you like a more in-depth product demo and further details about TaxWise Online? I have yes, I have no. And if you're already using TaxWise Online, great. Just go ahead and let us know. We love it when existing users come to these free resources that are prepared. But if you are thinking about maybe getting into taxes or making the switch, these presentations are typically hosted by me. And they're one-on-one. So we have a bunch of people that have joined today. This is a group presentation. A demo would be a place where you would be off mute. It'll be done virtually, but you would be off mute. I would be off mute, and we would talk through any questions that you may have. So if this is something where you're thinking about making the switch, but maybe you just want to see how things are going to work or get some specific questions answered, this is something that we offer. It's completely free. So just let us know. This will kind of signify to us to have a sales representative reach out to you, and we can definitely get a time booked at some date and time. The demo would most likely be with me. So hopefully you like today's presentation. However, there is one other person that you may be paired up with. So if this is important to you, go ahead, let us know. I'm going to give everybody a bit of time here to answer this. And then I will go and roll it back one slide where if you want that promo code, I'll just leave it there running for a couple minutes and then I'll end today's presentation.
In the meantime, there are some questions that came up if you're up for addressing them.
Probably don't have time right now. I do have to jump for another meeting here, but get me those questions after the fact, and I will do my best to email responses to them, as I should have everybody's email for who joined today. Okay, and with all of that being said, I do have to jump for another meeting. So want to thank you all for taking some time out of your day in order to learn about TaxWise. It looks like based off the responses, I will be giving some one-on-one demos to some of you here and look forward to working with you all in the future. Thank you so much and enjoy your weekend.